Welcome to the complete series recap for a SC 810 consolidation. This video covers all 8 sections, from the fundamental purpose of consolidation through the two-model framework, non-controlling interests, intercompany eliminations, foreign operations, deconsolidation, presentation, disclosures, and the audit and period-end requirements. Use this as a study aid, a refresher, or a pre-close review tool. Consolidation exists because the standalone financials of a parent company tell an incomplete story. The subsidiary appears as a single asset line. Dividend income only, no real picture of the subsidiary's operations. Consolidation replaces that single line with the subsidiary's full assets, liabilities, revenues, and expenses, presenting the group as if it were one company. The question that drives every consolidation decision is whether a controlling financial interest exists. A SC 810 gives us two completely separate frameworks. You always start with the voting interest entity model. If it applies and majority voting interest exists, consolidate stop there. Only if the entity fails the VOE analysis or shows characteristics of a VIE do you move to the second framework. The two models are mutually exclusive. You never apply both to the same entity at the same time. The voting interest entity model triggers at majority ownership, more than 50% of voting stock, directly or indirectly. But 4 exceptions override majority ownership. The entity is a VIE, severe government or legal restrictions prevent control. The holding is temporary with disposal planned within 12 months, or the holder is an investment company. Indirect ownership chains count fully, and potential voting rights are only factored in when they are currently exercisable, not future rights. An entity is a VIE when any one of 3 conditions exists. Insufficient equity at risk. The entity needs outside support to operate. Equity holders lack power over the most significant activities. Voting rights don't reflect real control. Or equity holders don't bear the normal exposure to the entity's gains and losses. One condition is enough. This is the test teams most commonly apply incorrectly by looking for all 3 conditions. A variable interest is any arrangement where your economic outcome varies with the VIE's performance, equity, subordinated loans, guarantees. Fixed fees are not variable interests. Among all parties with variable interests, only the primary beneficiary consolidates. The primary beneficiary must have both power over the most significant activities and the obligation to absorb losses or right to receive benefits that could be significant. Power alone is not enough. Economics alone is not enough, both in the same entity. VIEs appear most commonly in securitization special purpose vehicles, real estate joint ventures with disproportionate return structures, and lease entity SPEs. In each case, the primary beneficiary analysis is fact-specific, but the pattern is consistent. The party with power over the significant activities and meaningful economic exposure consolidates. And the VIE assessment is not a one-time exercise. It must be updated whenever facts and circumstances change. Non-controlling interests are always equity. No exceptions. The consolidated income statement shows total group net income, then splits it, the parent's share and the NCI's share, both on the face. NCI continues absorbing its proportionate losses even when the balance goes negative. This is different from the equity method, which stops at 0. And dividends paid to NCI holders reduce the equity balance. They are not an expense. When the parent sells some shares but keeps control, it is an equity transaction, full stop. Adjust NCI and a PIC no gain, no loss on the income statement. The group still controls the same assets and liabilities, only the distribution of equity has changed. The NCI roll forward tracks the balance each period and must reconcile to the equity section of the consolidated balance sheet. Intercompany eliminations remove all transactions between group entities from the consolidated statements. The investment and equity elimination is performed every period. Revenue and COGS are eliminated for all intercompany sales. Unrealized inventory profit requires 2 separate entries. the sale elimination, and then the separate inventory profit deferral. Intercompany receivables and payables are eliminated, so are intercompany dividends and interest. The most common intercompany elimination mistake. The team eliminates the intercompany sale revenue and COGS correctly and considers the work done. The unrealized profit still sitting in the buyer's ending inventory is left in. The result is overstated inventory and overstated gross profit on the consolidated statements. The fix is always asking, how much of the intercompany sold goods remains in ending inventory, and running the second entry to defer that profit. Foreign subsidiary financials are translated into the parent's reporting currency before consolidation. The current rate method applies when the subsidiary's functional currency is its local currency. Assets and liabilities at the closing rate, revenues at the average rate. Exchange differences accumulate in OCI as the cumulative translation adjustment. The remeasurement method applies when the subsidiary operates in US dollars, monetary items at the closing rate, non-monetary at historical rates, and exchange differences hit the income statement immediately. When control of a subsidiary is lost, deconsolidation follows 5 steps. Remove all assets and liabilities. Remove the NCI balance. Recognize any retained interest at fair value, not at previous carrying amount. Reclassify the accumulated CTA from OCI to the income statement. Then calculate the gain or loss, proceeds plus fair value of retained interest, minus net assets removed, minus NCI removed, plus CTA reclassified. Forgetting the CTA reclassification is the most common deconsolidation error. The presentation requirements under a SC 810 are mandatory, not disclosure options. NCI is always within equity. Income attribution, the split between controlling interest and NCI, must be on the face of the income statement, not relegated to footnotes. VIE assets and liabilities must be separately disclosed because the ring-fencing matters. VIE creditors can only access VIE assets, and those assets are not available to the parent's general creditors. OCI is also split between the parent's and NCI's shares. The ASC 810 disclosure package covers 5 areas. First, consolidation policies, what is included and why. Second, for each consolidated VIE, the nature of involvement, the balance sheet amounts, the maximum exposure to loss, and the creditor recourse limitations. Third, for unconsolidated VIEs with significant variable interests, the maximum loss exposure and how it arises. Fourth, NCI disclosures. Fifth, any ownership changes or deconsolidation events during the period. The fundamental difference between US GAAP and IFRS on consolidation. A SC 810 uses 2 separate models applied in sequence. IFRS 10 uses one principles-based definition of control, power, exposure to variable returns, and the ability to use power to affect those returns applied to every entity. There is no separate VIE concept under IFRS. When converting from IFRS to US GAAP, every structured entity must be reassessed under the ASC 810 VIE model from scratch. The IFRS conclusion does not transfer. There are meaningful areas of convergence. NCI is within equity in both frameworks, and NCI absorbs losses below zero in both. But divergence exists where the framework's different structures lead to different conclusions. Potential voting rights. US GAAP requires current exercisability. IFRS uses a broader substantive standard. And some entities with thin equity are VIEs under a SC 810 that would not be consolidated under IFRS 10 if no party passes all 3 control elements. The 6 common consolidation mistakes each have a specific root cause. VIEs in service contracts are missed because teams limit their scope to equity investments. The VIE model is skipped when teams rely on the VOE analysis alone. Inventory profit is left in because teams run only the sales elimination and miss the separate inventory entry. NCI as a liability persists from pre-2008 guidance. Gain or loss on partial sales while retaining control comes from treating the transaction as a disposal rather than an equity transaction. And CTA stays in OCI on deconsolidation because the reclassification step is overlooked. Auditors look for 5 sets of documentation: an entity list with the basis for each consolidation or exclusion decision, VIE analyses updated each period, not just at inception, an intercompany transaction summary confirming all balances reconcile, an NCI roll forward tying to the balance sheet, and a consolidation work paper, standalones plus eliminations equals consolidated totals, agreed to the final financial statements. For foreign subsidiaries, add the functional currency determination, translation rate work paper, and CTA roll forward. The consolidation process runs through 3 levels of responsibility. Team members perform the initial work and flag anything unusual immediately, not at submission time. Team leads review everything and escalate judgment-based conclusions and significant estimates to the manager. Managers approve all judgment calls, review and approve the disclosures, and sign off before the statements go out. The most important behavioral rule: escalate early. Holding judgment items for the review cycle creates delays and rework. The period-end checklist keeps the consolidation process complete and defensible. Start with scope. Update the entity list. Assess new entities under the VOE model, then the VIE model. Update the primary beneficiary determination for any VIE where facts have changed, and review any changes in ownership or contractual arrangements. A change in any of these could change the consolidation conclusion, and the documentation must reflect current facts, not last period's assessment. In the eliminations section of the checklist, confirm all intercompany transactions are identified and reconciled between entities. Eliminate revenue and COGS in full. Separately identify and eliminate unrealized profit in ending inventory. Eliminate all intercompany receivables and payables, dividends, and interest. Each line on this checklist corresponds to a common failure mode. The checklist is only effective if each item is genuinely verified, not just signed off. The final checklist items: NCI roll forward completed and confirmed to agree to the equity section of the balance sheet. NCI presented within equity, no exceptions. Income attribution shown on the face of the income statement. And the consolidation work paper complete standalone financials for each entity, the eliminations column, and consolidated totals that agree to the final statements. When every item is checked and documented, the consolidation is complete. Standing back, the ASC 810 framework comes together cleanly. Does a controlling financial interest exist? If yes, consolidate. The VOE model tests majority voting rights with 4 narrow exceptions. The VIE model tests 3 conditions and then identifies the primary beneficiary through power and economics. Once the scope is established, the mechanics follow. Present NCI within equity, perform all 6 intercompany eliminations, translate foreign subsidiaries appropriately, and deconsolidate when control is lost. Each piece connects to the others. Here is what to carry from the complete series. Consolidation exists to present a corporate group as a single economic entity, and it is triggered by the existence of a controlling financial interest. The 2-model framework tests that question: VOE first, VIE if needed. The VIE primary beneficiary test requires both power and economics in the same entity. The mechanics: 6 eliminations, NCI within equity, CTA accumulating in OCI until deconsolidation. Execute the consolidation accurately. Audit documentation, roles, and the period-end checklist are the controls that ensure the process is complete and defensible. You now have the full framework. Use it well. Thank you for completing the ASC 810 Consolidation Complete Training Series. Thank you for watching. Subscribe for more training from PNJ Group.